so many factors today in the economy. You have geopolitical tension, you have domestic disruption, as well as supply chain challenges. And what else is going on? Inflation, the Fed, interest rates. Today, we're going to talk about a lot of these things and what it is that you need to know about a potential market crash in 2022. Today, the highest inflation in 40 years, right? Inflation hit a 40-year high in February of 2022 as the consumer price index jumped up to 7.9%. By the way, at the time of filming right now, it's at 8.5%. This is the fastest pace since 1982, and that's up from 6.8% annually in November, which was nearly a 4-decade high. So what does that mean? Well, the challenge that we face with inflation is that the buying power of your dollar gets diminished, right? Price of everything goes up. And so that dollar that you would normally spend, or that $2 for a gallon of gas that you were paying, is now $5 a gallon, right? So if you're on a fixed income or you make a certain amount of money every single week, every month, well, that money didn't miraculously go up, but the price of everything else did, so your buying power is diminished. And the way that they're going to try to get this under control may also hurt your purchasing power when it comes to other things. So stocks are overvalued. I'm not saying that, but who is saying it is Tematica Research's chief strategist, Lenore Hawkins. And what she is saying is, we have never seen equities priced quite this high. The adjusted price to earnings ratio is pushing up against 40 times. The last time we saw that was in 1999. And you guys all remember 1999 and the dot-com bubble, right? But what if you looked at the price to sales ratio? That's over 3 times. That's higher than what we saw during the dot-com bubble. Now, are prices of stocks overvalued? I think that's a company by company decision, right? And what I mean by that is the price of a stock should be relative to what that company is earning and what we think that the future value, or what the market thinks the future value of that company is going to be. And so to just blanketly say that stocks are overvalued, I don't know that to be true. What I personally think is that there is a lot of manipulation in the stock market through interest rates being held so low. There's been a challenge for the last, let's say, 10 years, this really long run of great stock gains, but what was also happening at that same time? Interest rates were very, very low, and it was hard for people to find any sort of safe yield. Now what we're starting to see as interest rates begin to rise, we're starting to see prices and market volatility come back into play in ways that we just really haven't seen in quite a long time. So now we're going to talk about the Federal Reserve. And the important thing to remember about the Federal Reserve is, regardless of what you think about them, they are mandated from Congress to take on and tackle a couple different things that happen in the economy. One of their mandates is to maximize employment opportunity. But another thing that they need to do is create stability and have stable long-term interest rates. Well, if we look at what's been happening, interest rates have been very, very low for a very long period of time. And so one of the things that they need to start doing as inflation comes in is they're looking at raising the federal rates. So from Chris Zaccarelli, Chief Investment Officer of the Independent Advisor Analysis, the stock market is especially vulnerable to the Fed's increase in rates. Why? Because we just talked about that, right? With low interest rates, people are in the market because there's really nowhere else to find yield or return. But now as interest rates start to creep up, there's going to be other more safer fixed investments that people can put their money into. So the market becomes vulnerable, and the removal of the tailwind that the Fed's asset purchases have provided for the past 2 years, we're now concerned that the volatility we have already witnessed in January will increase in the months ahead, and would exercise caution in the near term. Now, that's Chris Zachariah saying that, right? But you do have to think about all of the different tensions that have gone on since he talked about this in January, right? What other things and market disruptions have we seen? And the Fed, by the way, I'm not sure when you're seeing this, but they've come out and they've said that they're committed to 11 interest rate raises over the next 2 years. So that's, we've gone from no interest rate hikes to now all of a sudden on the table, there's the possibility of 11 interest rate hikes to tame inflation, which, by the way, they were telling us for a long time was transitory, and we see that it's not transitory. Those interest rate hikes may also equal more volatility in the market. Now, what we're going to talk about is the reality of things, right? Obviously, the Federal Reserve coming in, raising interest rates is going to cause uncertainty. The fact that certain people are thinking that prices of stocks are overvalued may also cause more uncertainty. And we're just coming out of now what was a 2-year global pandemic, right? So the world looks a whole lot different than it did just 2 years ago. Let's talk about the reality of this, right? So while we have ongoing pandemic, continues to be a primary driver behind the current market turmoil, the stock market doesn't need and never needed a pandemic to hit record highs one day and enter into correction territory the next day. And really, it's not so much the pandemic itself, but everything that was caused by the pandemic. Shortages in housing supply, shortages in labor supply, and supply chain disruption in general has really changed the face of what it looks like to be a purchaser of goods here in America today. What does this mean for you? Well, one, you need to diversify, right? But everybody says diversify. So what does that really mean? We're talking about having a portfolio that's constructed of different assets that will on average yield higher long-term returns and lower the risk of any individual holdings or securities. In English, what that means is that if you have a portfolio of different companies, different things, right? And they don't all have to be stocks, right? You could own real estate, you could have a business, you could have a certain fund that tracks a bunch of different companies. All of those things at different times, some will perform better than others, some will go lower, some will come up higher, right? And having that offset of risk and knowing that long-term markets perform, long-term real estate performs, long-term hopefully your business is performing or other businesses that you may be in are performing. Having a long-term view and not a short-term like, hey, I'm going to put my money in here and in 6 months I'm going to quadruple it, or I'm going to make 10x my money in the next 3 months on this investment. That's a risky way to run your life. That's a risky way to handle your investments. And so having a long-term approach, no matter what age you are, right? Because if you're 65 right now watching this video and going, hey, I don't have a long-term approach on my investments because I need to start taking money now. Well, what you should be looking at is ways to bucket out certain money for today and money for the long-term future, because you still need to hedge against inflation. What's the solution? So the solution in this slide, anybody who watches our channel, they know how much we love life insurance as well as other investments, but life insurance particularly because a lot of people don't necessarily understand it. They haven't been taught about it. And so let's just read this slide here, right? So a life insurance policy has guaranteed returns regardless of the stock market. While you may not earn as high yields as the stock market, it is a safe place to store cash and a good hedge against inflation. So why do we say a good hedge against inflation? Well, when inflation is at 2-3% and your guarantees inside of the life insurance contract are matching up with that, that's a great way to hedge inflation on the cash values there. Much better than having it sit inside a bank earning zero. Most of the good life insurance companies, at least mutual life insurance companies, will pay a dividend. That dividend now brings it up even higher. Are you pacing inflation today? Well, not if it stays at 8.5%, but it's still much better growth than sitting in the bank at 0%. So How does this play in? When we just talked about diversification, using life insurance as another savings tool to either create a tax-free retirement income in retirement, or to use it as a volatility buffer, a hedge against market volatility when you're in retirement, right? Think about it. If the market drops 20 or 30% in any one year, and you now have to take money out to live on because your whole portfolio has been invested, and that's the only money you have, so you now take it out, you've now essentially locked in the losses that you saw in that year, taken the money, and that's really disrupted your portfolio. What if you had another bucket of money over here, cash value and life insurance? The market declines, but your cash value doesn't decline, right? Your cash value holds solid, and now you draw the money from there. That allows your money to stay invested and see the returns in the market maybe a year or two later, right? So diversifying yourself is important, not just in your portfolio of stocks and bonds, but in and amongst asset classes. And life insurance can be one of those asset classes to add into. So if you're concerned, right, about the market declines, bubbles, where are you in your portfolio and your economic journey, and you'd like some help, right? You want to talk to somebody, click in the description box below. One of the strategists here at Epic will reach out and they'll take you through a game plan, figuring out where on the financial freedom roadmap you are today, right? Get an understanding of what it is that you're trying to accomplish, the things that you've done up to this point, how that all fits together, and are there other things that you can be adding in to help you get there in a more safe, a better, or a faster manner. If you're here with us now at the end of the video, thank you so much. We're putting out new content like this every single day. Go ahead and click that subscribe button. And if you really did enjoy the content, give us a thumbs up.